It has been a roller coaster ride for WP Carey stock, but down the line the stock is down 12% year to date, while most REITs have seen a bull run in the recent months. Looking at the earnings, we see that they missed on FFO big time, while beating on revenue. A thing that most people like about this stock is the fact that they pay a 6% dividend yield, and this could potentially boost your average yield big time. And probably you already know that the company is changing a bit with the tenants and industry focus. So more on that in a minute. First I want to show you this graph. And this one is one of the main concerns for most people. In the past 5 years, WPC had a minus 8% return, while the S&P 500 returned 108%. And keep in mind, this is including dividends. But of course this doesn't mean anything for the future. So let's dive in the most recent earnings report and do a fundamental analysis. By the end of the video, I will show you my 3 price targets. So, as said a second ago, WP Carey reported mixed earnings, according to the analysis. When we dive in the actual numbers, we see that revenue is up slightly year over year. Operating expenses are down, which is a really good sign to me. However, other income and expenses are down much more, resulting in a lower net income and EPS. And especially the EPS is a bit concerning to me, reported at $0.51, down from $0.65. Taking a look at the portfolio, we see that in total WP Carey has 1,430 properties and 346 tenants. North America represents 64% of the revenue, and Europe is sitting at 36%. The weighted average lease term or WALT is at 12.2 years, which is not too bad, especially in combination with the nearly 99 occupancy rate. The top 10 tenants represent only 20% of the total ABR, which is also looking really good to me. Extra space storage is the biggest tenant, with only 2.7% of the total ABR. Again, looking really good. Diversification is really on point with this company. As of right now, industrial is the biggest industry with 35%. Warehouse is the second biggest with 28%. Again, looking pretty good to me. Looking at the tenant industry, we see that retail stores is by far the biggest with 23%. And to be honest, this looks pretty decent to me as well. The same store ABR is decreasing in the recent quarters, so definitely something to keep your eye on, since you want this number to increase. And as mentioned before, the WALT is looking pretty good for this company, especially since 54% of the leases expire after 2035. And now that we know a bit more about the company, it is time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. WP Carey is a 13 billion market cap company. PE ratio is not a fair metric to use with REITs, so I'll be using the price to FFO instead. Right now it is sitting around 12, indicating they might be undervalued. Later in this video I will show you my 3 price targets for WP Carey stock, so make sure to watch until the end, because price to FFO is only telling a small part of the full story here. Revenue is at 1.6 billion, and in this graph we see that revenue went up in the long run. To me, this looks really good. However, in the recent quarters, revenue is coming down quite a bit. We see that margins are going up in the long run. This also looks really good to me, especially with the revenue going down a bit. You want the margins to increase. EPS is going up in the long run. It is not always steady and consistent, but that is very common for REITs. Analysts expect that in 2025 EPS will decrease again, which is really sad to see. but in 2026 it is expected to see a 12% increase. For the revenue, it is looking pretty interesting, with some smaller growth numbers for 2025 and 2026. But 2027 is looking really interesting with some high growth numbers. Return on assets is sitting at 3.1%, which is a low number, even for a REIT. Return on equity is looking decent. And most important number, return on invested capital is sitting at 3.3%, which is again a low number. But it is slightly higher versus the 5-year average, so that's the silver lining here. Current ratio is at 1, which is a great number. Nothing really special to mention here. And right now WPC has 8 billion in debt. I prefer companies that can pay down at least a big chunk of their total debt with the total cash. WPC has 820 million in total cash, so they can't pay down a big chunk of their total debt. This is something that I don't like. So it is very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is going up and down a lot. So this is something to keep your eye on as well. Shares outstanding are increasing, which is very common for a REIT, since they increase shares to raise capital. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the P/E ratio, and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 6%, which is a great number. Annual payout is at $3.50, and payout ratio is at 76%, which is exactly at the 75% average for REITs. There are no growth streaks since they cut the dividend. In here we see the dividends paid since 2014. They increased the dividends at a low rate. However, in the long run this really adds up. But ever since 2019 they slowed down big time in increasing the dividends, up to a point where in 2023 they cut the dividends a little. In this graph we see the expected dividends in 2024, 2025 and 2026. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It is expected to go down from here. And overall these dividends look really interesting to me. But how about the historical returns? I decided to compare WP Carey stock with the overall market, in this case the S&P 500. On the 5-year chart we see that WPC had a minus 7% return. And keep in mind this is including dividends. And right off the bat this looks really terrible. The S&P 500 however is sitting at a 105% return, beating WPC big time. On the 1-year chart it looks pretty interesting, with the S&P 500 beating WPC again with a big difference. On the 6-month chart it is not any difference, but this time WPC managed to get at least a positive 5% return, and it was doing a better job for a short period than the S&P 500. On the 1-month chart it is the S&P 500 who is again the winner. So bottom line, WPC underperformed the S&P 500 long term and short term. And with the stock hammered down a lot, could this be the perfect time to buy WPC stock? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth, I'm filling in 6, 8 and 10%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin, I'm filling in 30, 33 and 36. And for the free cash flow margin, I'm putting in 60, 65 and 70%. For the PE ratio, I'm putting in 20, and for the price of free cash flow, I'm putting in 7, 9 and 11. My desired annual return is 15% since I can get an easy 10% average annual return with owning an ETF. Usually I put in 12.5%, but I want to build in a higher margin of safety here. And right now WPC stock is around $57. I hit analyze and we see a lot of red numbers. And since this is a REIT, I'm only focusing on the discounted cash flow value. We have a low price target of $40, we have a mid price target of $54, and we have a high price target of $72. To me, the mid price target is the most justified here, indicating that this stock is overvalued right now. Which price target do you think is the most justified here? Let me know in the comments down below. My final conclusion on WPC is that it is an interesting company that drastically changed its business. It has been a while now since they did that, but to me it looks like they are not quite there yet. Looking at the fundamentals, I think everything looks pretty decent. However, there are a few concerns, such as revenue growth and the fact that free cash flow is not steady and consistent at all. Looking at the dividends, I also do get really excited. The yield itself is pretty high, but there is a big problem. The growth isn't really there, and cutting dividends is never a good sign to me. So definitely keep an eye out on these numbers. Looking at the valuation, I think it is overvalued, but also because they aren't recovering that great so far. As of right now, I do think there are better REITs out there that could be bought. So for now, I'm skipping this stock, but I will keep analyzing them from time to time. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.